Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, heading into today's open. A calm surface masks a violent rotation, with the Dow plunging nearly 1% while the S&P clings to highs. Will this historic divergence trigger a market-wide reversal at the bell, or will AI titans continue their siege? Second, US secures $250 billion chip deal. A 100% tariff threat triggers geopolitical shockwave. Washington's power play forces a massive supply chain realignment, but with US-made chips costing up to 20% more, will this historic onshoring effort ignite inflation and crush tech hardware margins at the open? Finally, BlackRock shatters records with $14 trillion AUM, but a shocking paradox rocks Wall Street. The asset king stock lagged the market, creating a valuation puzzle. Now, with a massive pivot into AI infrastructure, will this earnings beat finally silence the doubters and trigger a historic comeback? A seemingly calm day near record highs, but undercurrents are surging violently. The market is witnessing a historic bifurcation where broad index gains mask a brutal rotation under the surface. While the S&P 500 demonstrates resilience, capital is aggressively fleeing cyclical sectors in favor of a narrow cohort of AI beneficiaries and financial powerhouses. The headline numbers tell a deceptive story. The S&P 500 pushed to 6,971 points, gaining 0.39% to hover near historical highs. However, the Dow Jones Industrial Average plunged nearly 1%, shedding 473 points in a single session. This divergence is not random noise. It represents a structural repricing of risk. The Nasdaq composite remains caught in the middle, balancing strong earnings from semiconductor giants against the gravitational pull of rising interest rates. This is a barbell market. Capital is flowing into mega cap AI technology and prime brokerage financials, while the industrial heartland is being hollowed out by tariff uncertainty and rate fears. The primary driver of this volatility is a paradoxical economic backdrop. We are seeing a Goldilocks risk scenario that complicates the Federal Reserve's path. On one hand, consumer spending remains surprisingly robust, with December retail sales surging 1.2% month over month. The consumer is still spending, which fuels inflation expectations. On the other hand, the labour market is flashing warning signs. While jobless claims dropped to 198,000, the critical JOLTS data reveals that job openings are collapsing. This signals that employers are hoarding current workers but have stopped hiring, a classic precursor to economic deceleration. This data conflict is forcing a hawkish reset in bond markets. Traders have largely abandoned hopes for early rate cuts. December 2026 Fed funds futures have risen to 3.18%, the highest level since August. The market is waking up to the reality that the Fed may hold rates steady through the first half of 2026. Consequently, the 10-year Treasury yield is testing 4.15%. Analysts warn that if next week's PCE inflation data comes in hot, specifically if core PCE exceeds 2.6%, we could see yields spike toward 4.6%. Such a move would be mathematically hostile to high valuation growth stocks, forcing a compression in price to earnings multiples. In the corporate arena, the bifurcation is stark. The semiconductor sector is decoupling from the broader tech market, driven by voracious demand for AI infrastructure. Taiwan Semiconductor, or TSMC, delivered a massive beat with $33.7 billion in revenue and guided for nearly 30% growth in 2026. Critically, management upgraded their long-term AI revenue forecast to a mid to high 50% compound annual growth rate. This confirms that the AI capital expenditure cycle is not slowing down. However, weakness in broader software names suggests investors are becoming selective, demanding tangible earnings from AI investments rather than just promises. The financial sector is telling a tale of two economies. Goldman Sachs reported a 20% surge in net earnings, driven by a boom in deal-making and prime brokerage services. Wall Street activity is exceeding 2021 peaks. Yet, looking at the balance sheets of major banks reveals cracks in the consumer foundation. JP Morgan's $2.2 billion reserve build for its Apple Card portfolio signals emerging stress in consumer credit, While investment banks profit from hedge fund leverage and mergers, lenders exposed to the average consumer are preparing for higher default rates. Meanwhile, the industrial sector is buckling under the weight of trade policy, with average US tariffs on Chinese imports now sitting at 47.5%. Companies with complex global supply chains are freezing capital expenditures. This uncertainty explains the sharp sell-off in the Dow Jones. Until the Trump administration clarifies its tariff strategy, industrial heavyweights lack the visibility required to commit to long-term growth projects. Looking ahead, the market is entering a critical observation window. The immediate focus is on the upcoming PCE inflation data, expected January 22nd. This is the Fed's preferred inflation gauge, and a high print would likely cement the higher for longer rate narrative. Furthermore, the sustainability of the tech rally hinges on NVIDIA's earnings report in late February. Analysts view NVIDIA's forward guidance on data center demand as the single most important data point for the first half of the year. The market rhythm has shifted from a broad rally to a game of survival of the fittest. We are seeing a rotation where liquidity is abundant for companies with pricing power and AI exposure, but scarce for cyclical businesses facing tariff headwinds. The indices may look calm, but the internal mechanics of the market are grinding gears. The next few sessions will determine whether the S&P 500 can maintain its valuation premium in the face of rising yields, or if a broader correction is necessary to realign prices with the interest rate reality. Heading into today's open, a seismic shift in the global tech war. The United States has secured a $250 billion investment from Taiwan for American chip manufacturing, in a deal being framed as a direct power play. A while back, we flagged how TSMC had become a single point of failure for the AI supply chain, controlling the vast majority of advanced chips. What we're seeing now is Washington trying to pull that choke point closer to home by force. Overnight news reveals the Commerce Department cut tariffs on Taiwanese goods from 20 to 15%. The price for that discount? A staggering $250 billion in commitments from Taiwanese tech companies to build chip factories on US soil. This builds on our earlier discussion of the investment tsunami. TSMC alone has been pouring massive sums into new fabs, and this package now accelerates and concentrates that capex inside the United States. Now, that $250 billion represents a massive acceleration of capital spending. Of course, money alone can't build factories overnight. The biggest hurdles are labour and costs. Research from Deloitte highlights a significant labour shortage, with the US construction industry needing nearly 500,000 new workers by 2026. On top of that, building a high-tech chip fab in the US costs about twice as much and takes twice as long as in Taiwan. A few days ago, we also noted that power is becoming a parallel bottleneck, so you have to watch for potential delays and cost overruns that could create a medium-term inflation risk for all electronics. This is where the situation takes a more complex turn, the threat that forced the deal. Commerce Secretary Howard Lutnick put it bluntly, stating that if companies don't build in America, the tariff is likely to be 100%. That threat remains on the table. We previously analysed how choke points can be weaponized. Today, we're seeing that logic formalized into a policy lever. You know, this isn't just a one-off threat. It's actually becoming a core part of US industrial policy. The strategy is to use the threat of high tariffs to pressure foreign companies into making direct investments in the United States. As we've discussed before, while this can create jobs and trophy projects, its long-term effectiveness is debatable. Research from the US International Trade Commission shows that past tariffs did reduce imports, but also led to higher prices for American consumers. It's a double-edged sword. The most incendiary detail, however, comes from Lutnick's explanation for why Taiwan agreed. In a statement sending shockwaves this morning, he said Taiwan struck the agreement because, quote, they need to keep our president happy, adding that, quote, Donald Trump is vital to protecting them. Today's comments underscore the explicit security politics linkage behind the reshuffling of the supply chain. Strategically, this all ties back to Taiwan's famous Silicon Shield. For decades, Taiwan has made itself indispensable to the world economy through its dominance in chip manufacturing, believing this was its best defense. This new deal represents a major evolution of that strategy. By investing so heavily in the US, Taiwan is diversifying its shield, using economic statecraft to deepen its security ties with America. It's a high-stakes hedge. The long-term risk for Taiwan is that it could hollow out its own domestic industry and reduce the very geopolitical indispensability that has kept it safe. This forces a massive realignment of the semiconductor supply chain. Taiwan Semiconductor, ticker TSM, is confirmed to be a leader in this new investment. A while back, we highlighted how its most advanced factories were running flat out with gross margins approaching 60%. The open question now is how much of that margin can survive US build costs that are structurally higher. Naturally, the ripple effects will be felt globally, especially in China. This US-Taiwan deal effectively secures future advanced chip capacity for America, which will only intensify China's state-led push for its own semiconductor self-sufficiency. China has already launched the third phase of its big fund, a massive $47.5 billion state fund to bolster its domestic chip industry. The concern here is that as China floods its own market with domestically produced legacy chips, it risks creating a global supply glut. At the open, watch for how this long-term threat of a price war could affect global semiconductor companies. Ahead of the bell, all eyes are on the semiconductor sector. This isn't just a trade deal, it's a forced relocation of a critical industry. What we need to watch for is the new cost structure this creates. Onshoring will structurally increase the cost per chip. For example, AMD's CEO has acknowledged that chips from TSMC's new Arizona facility are 5 to 20% more expensive. This reinforces the pressure we noted from the Semiconductor Producer Price Index, which some strategists warned could keep inflation above target. While this is a huge potential win for semiconductor equipment makers, it creates a persistent inflationary headwind for the entire tech hardware sector. So heading into the open, look for movement not just in chip stocks like the ETF, SMH, but also in the big hardware names that will have to absorb these higher costs. Speaking of the immense costs and inflationary headwinds in the tech build-out, let's turn to the money behind it all. The world's largest asset manager, BlackRock, just dropped a number that is shaking Wall Street, $14 trillion. That's a new record for assets under its management. The company announced this overnight after shattering Wall Street's profit estimates, posting earnings of $13.16 per share when analysts were only expecting $12.21. The surge was fueled by a record-breaking year for investors pouring nearly $700 billion in net inflows into its funds. However, if you zoom out, you'll see a fascinating duality. Despite these colossal numbers, BlackRock stock, ticker BLK, actually underperformed the S&P 500 last year. The company with more money than anyone else couldn't beat the market. A while back, we talked about how the AI boom can both supercharge productivity and stoke costs, a tension that can keep multiples in check and has been part of the overhang. So what's really going on here? This isn't a random fluke. This valuation puzzle suggests investors have been skeptical, questioning whether a firm of this colossal scale can maintain its growth trajectory. Essentially, the market seems to be pricing in concerns about BlackRock's strategic pivot and whether its sheer size is becoming a handicap. At the open, the big question is whether this earnings beat is strong enough to finally silence those doubts. Now, that sentiment might be changing. In response to the stunning report, shares of BlackRock are jumping sharply in pre-market trading. The company also announced a 10% dividend hike and a major share buyback, signaling massive confidence. This confidence is built on those massive inflows. Interestingly enough, these fund flows, especially into fixed income products, act as a real-time barometer for the market's view on Federal Reserve policy. For example, the iShares 0 to 3 month Treasury Bond ETF, ticker SGOV, has seen over $35 billion in inflows, a clear sign that investors are flocking to safety and yield. A few episodes ago, we noted some investors believe the most overlooked risk for 2026 is AI-driven inflation. If that narrative gains traction, it could be the catalyst for the kind of rotation we're watching, either reinforcing the dash into cash or snapping it back. A sudden reversal in these fixed income flows could be a primary signal that markets are getting nervous again about a higher for longer rate environment. Adding to the drama is a direct quote from CEO Larry Fink, who declared the company is entering the new year with accelerating momentum after the strongest year and quarter of net inflows in our history. BlackRock is also making a strategic pivot, pushing hard into higher margin private markets and AI-linked assets like data centers. This moves them beyond their traditional low-cost fund business. We previously analyzed the AI build-out as both a growth engine and an inflation wildcard. Now, BlackRock is positioning to finance the pipes and power underneath it. This is a two-pronged strategy with huge implications. First, the push into private markets. The trend here is the retailization of private equity, and BlackRock is at the forefront of moving these traditionally exclusive assets into mass market retirement plans. While this could offer higher returns, it also introduces new risks, like a potential liquidity mismatch if many people try to sell during a downturn. Second, and perhaps more dramatic, is the bet on AI-linked assets. After all, the AI revolution requires an almost unimaginable amount of electricity. Believe it or not, this is forcing tech giants to make unprecedented moves. For instance, Meta has already secured over 6 gigawatts of nuclear power for its next-generation data centers. We've flagged before how the scramble for advanced chips and power can create its own inflationary pulse. Deutsche Bank even estimated AI data center spending could reach $4 trillion by 2030, turning this build-out into a macro engine. BlackRock's investment here is a bet on a massive new capital spending cycle for AI infrastructure. This all sets the stage for a major test at the opening bell. The swing factor is whether investors believe BlackRock can monetize the AI capex wave without getting caught on the wrong side of AI-driven inflation and a higher for longer Fed. We'll be watching to see if these record-shattering results can finally convince the market that BlackRock is ready to outperform, not just grow.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.